The assumption is that interest rates in the UK have now reached their peak. It was August 2023 the last time the Bank of England made any changes to the rate, and since then, they've been held at the 5.25% level. Today, the Monetary Policy Committee met again and voted on the direction for the base rate, and for the first time since the financial crisis in 2008, there was a three-way split vote according to the BBC. Two of the members wanted to increase the rate, one wanted to drop it, and then three, the winners, held it where it was. This divide speaks to the uncertainty that now exists on what's next for the UK economy and its direction, as we go from this period of inflation to a potential recession or who knows what else. Today, we're going to look at the monetary policy report that accompanies this decision and look at what the bank is saying about the UK economy and when we're likely to see interest rates fall. I don't just want to brush over the significance of this three-way split vote. Andrew Bailey, the top man at the Bank of England, is coming out with a very strong message today. We need to see more evidence that inflation is set to fall all the way down to our 2% target and stay there before we can lower interest rates. The Monetary Policy Committee produced this chart which tracks their forecast for the path of inflation. They expect it to decline rapidly to the 2% target by about April this year, before rising again in the spring and summertime, then staying above the 2% target for 2025, only appearing to find the target again in mid-2026. First of all, I'd like to remind you that the 2% target that central banks all over the world hold so dear was made up on live television by a finance minister of New Zealand in the 80s. It was literally an off-the-cuff remark that he just threw out there that became one of the most influential targets on the planet. I would also like to remind you that the forecasts of the Bank of England are a bit like horoscopes. They make sense if you look at just one, but if you go back and read a few of them, you see that the predictions are just all over the place. I wouldn't be surprised, honestly, if in 12 months the whole narrative around this has changed again and they're considering raising rates to combat the more sticky embedded components of inflation. That's that worrying stuff that's really hard to get rid of once it's locked in. I'm not saying that will happen. I'm just pointing out that, as we've looked at multiple times on this channel, the core and service-based inflation remains a concern. Last month's inflation figures, so the ones for December, showed that services and so-called core inflation, which is inflation after you strip out food, energy, booze and tobacco, hadn't moved at all, in fact increased slightly. In a way, this is really the Bank of England's job to keep this section of the inflation problem under control, because the non-core stuff like energy and food, as we've seen over the last few years, is highly volatile and often susceptible to external influences. So the huge inflation shocks that we've seen in recent years are down to monumental amounts of money printing, let's get that out of the way first, but also external shocks like COVID and the war in Ukraine. As the impact of those shocks that we've seen unwinds and diminishes, inflation tends to fall away. An example of this is the impact of energy prices in orange here. It rose and pushed the inflation rate up that you can see as the white line, and as that influence has fallen, so did inflation. But when the quick wins are all gone, we're left with the stuff that's underneath. The Bank of England often refer to this as the second round effects. So the big shocks cause these ripple effects, and they argue that that causes second round inflation in things like core and service components. Consistently remark that this sort of inflation will take longer to unwind than it did to emerge. But if Bailey's good to his word and says that he won't drop rates until we see a permanent move to the 2% target, well, the sign that this is coming will be these core numbers and service numbers falling. And so far, that is not happening. The bank themselves are forecasting a steep decline in the service-based inflation, as you can see here, the bluey green line. It declines steeply basically from today is their guess. We'll get to see if that prediction comes true, won't we? And maybe then we'll see a bit of a step down in the rate at the next meeting if we see a large decline in these core numbers. But let's not forget that the Bank of England expects inflation again to tick up after dropping to 2%. And by his own words, Bailey says we'll be holding the rates higher until we hit the 2% target sustainably. Let's now look at the path that experts expect interest rates to take in the coming years. In this report by the Office for Budget Responsibility, on page 17, they set out their forecasts for the bank rate. Again, notice the change just between March's forecast and the one that they made in November when Venus aligned with Mercury. This chart implies that we'll see a decline in the rate through 2024 down to say 4.75%, but long term from 2027, the rate will sit at about 4%. The Bank of England in their report released today seems to believe that rates will sit closer to 3% by 2024. Anything can happen, but the general consensus now is we will see rates decline over the coming years. We won't be going back to the times of free money, but 3 to 4% by 2027 seems to be what they're all predicting. For my own personal financial situation, how I'm applying that to my life then is, if I'm looking to refinance on a mortgage, I'm probably doing that on a short-term basis in anticipation that rates will decline further. That's just me though. It's not a recommendation. And then any savings that I've got in cash that I don't need for a while, I'd be looking to lock in the highest rates possible, again, on the anticipation that rates will probably decline. But it wouldn't surprise me if in the next 12 months we're sat here going, yeah, we dropped rates, core inflation is still kicking, and now the rates have got to go back up again. Okay, something else that I want to discuss with you quickly that I think is relevant to individuals and our personal finances that's contained within the report. Coming back to this table, we can see that the Bank of England forecasts unemployment rates. This is because along with service and core-based inflation, the unemployment rate is a key indicator of how sticky the inflation problem is. They often refer to the labour market as being tight, and what the Bank of England are hoping for is the labour market loosens. Here is a fan chart from the Bank of England, and how these work. They show the range of the bank's predictions. The dark purple section is the forecast they think will happen, and as it fans out, they're saying, this could happen, we're just less and less confident that it will. This one looks at the unemployment rate, and most economists would say that an unemployment rate of between 4 to 6% is normal. And it just so happens that the bank's forecasts sit between these ranges. I do just want to say that these unemployment figures can be heavily manipulated by things like 0-hour contracts and part-time workers. But look at the range, it's massive, anywhere from 2% to 8%, which is the difference in about 2.6 million people being in or out of work, depending on which end of this fan chart we land on. Behind those numbers and the desire to loosen the labour market is the fact that many people will lose their jobs. The UK workforce is around 33 million people. A rise in unemployment of 1% means 330,000 people lose their jobs. What impact does that have on those people's lives? Or even on the demands on the benefit system, or just simply tax revenue? 330,000 less people paying into the system. There's a scene in The Big Short where Brad Pitt's character has a go at two young lads who have just cashed in on the financial crisis.
You know what I hate about banking? It reduces people to numbers. Here's a number. Every 1% unemployment goes up, 40,000 people die. Did you know that? No. So
there's actually some academic research to support the claim in this movie. It's not just Hollywood BS. It comes from this book by Barry Bluestone and Bennett Harrison. And it was released in the 80s, and it looks at the effects of corporations relocating to other countries. They cite a paper which reads, a 1% increase in the unemployment rate will be associated with 37,000 deaths, including 20,000 heart attacks, 920 suicides, 650 homicides, 4,000 state mental hospital admissions, and 3,300 state prison admissions. This is America, where the workforce is 5 times the size of the UK at 167 million people. And this was written in the 80s, so times change. But a rise in unemployment by 1% will have some very real, very negative effects on a large group of people in the UK. I don't want you to be one of those people. And this is a personal finance channel after all. So I'd really just encourage you to have a robust emergency fund in place, 3 months worth of living costs, just in case you lose your job. Just look at what happened to Wilco recently. I think rates sitting higher for longer will see more corporate casualties like this. I think some people are going to be shocked by the shift in tone as we go from people demanding higher wages to seeing people losing their jobs. So yeah, protect yourself and protect your loved ones by having access to easy access cash savings that can support you if the unemployment rate does rise, which I think it probably will. The effects of higher interest rates are still feeding into the economy after all, and the implied path for those interest rates is that they'll be staying at elevated rates for longer. So that means that people will be losing their jobs and facing higher costs of borrowing, with many people still yet to see the increases in their mortgages, yet to feel the pain of the rate rise. I think we're past the worst of inflation, but I do think that the symptoms of the cure are really still yet to kick in. I've linked all of the reports and all of the sources below for you that I've used in this video, as I always do. And I'll be back in a few days with something far more uplifting than this, because I'm all about the positive vibes in 2024. I'll see you soon, guys.